We think that this is an enduring environment for the fixed income market. And there's a couple of reasons that help to underscore that. It's the symmetry of returns in the bond market. That's what I'm saying is the income that you're getting is in the driver's seat. And if you start to think about potential upside of the market, there's certainly an opportunity. If there is some deterioration in the outlook, you can get some additional price appreciation in the market. But if we think about what really is driving fixed income, it's the second part of the term, income. And looking back 15 years in many parts of the market, there is a really great opportunity to say that you're picking up quite a bit of income that's attractive relative to history.
This is a very different and unique environment that we're in than we've been used to seeing, certainly.
It's a pretty exciting time right now to be in fixed income. It's a pretty exciting time, I think, from our side in terms of like looking at the opportunity set. I think from an investor perspective, and I'm an investor in addition to helping to manage money, it's a pretty exciting time just given where yields are right now. And in particular, I think it's a really exciting time as an active investor, right? Like, what does dispersion mean, right? Dispersion means that as opposed to things all kind of trading at the same level, you've got like the average level and then like basically nothing is trading at the average level, right? What dispersion means for us within fixed income, whether you look across asset classes, right, which is what this chart shows, whether you look across industry sectors, whether you look across, within sectors at the issuer level, dispersion for us is really translating into things trading at a very, very wide range, probably at the widest range that we've seen in years, probably since COVID, to be honest. And what that means for us as active investors is just a much wider opportunity set. All the things that you would look at from a financial perspective, from a bottoms up perspective in terms of like assessing the health of a company or of a market, you would say that high yield is in as good a place today than it's ever been, right? So when you think about why the market has seemed to have been able to bounce back every time it takes a hit, every headline that hits that results in some somewhat temporary volatility, and why it seems to always be able to bounce back from a fundamental perspective, one of the biggest reasons is just the foundation. The foundation of fundamentals today, and this is true certainly for high yield, I would make the same statement across corporate credit, is just the strength of the foundation today is such that it can withstand a lot more headline risk. When we think about high yield versus private credit, there's basically no overlap between the two in terms of like issuers, right? Issuers, if an issuer needs to finance, it doesn't use both markets. It chooses one or the other. Most oftentimes it's a sponsor that chooses one or the other. There's very little overlap between the two markets. And the reality is part of the growth that we've seen in private credit has come at the expense of the high yield market, right? Like the high yield market hasn't really grown over the last 5-10 years. And you can thank private credit, the syndicated loan market, which we haven't really talked about yet, as kind of contributing factors to, it's not like there hasn't been a lot of supply in the non-investment grade market. It's just this time, this cycle, it's gone into other markets, right? And so when you look at the composition of the high yield market today, and Sarah referenced some numbers around half the market is like the highest quality within high yield. Part of that is point in cycle, right? We've been in a very long kind of cycle. The reality of private credit, as Sarah mentioned, is it's a market that's grown a lot, has a lot of merit to it, right? There's a time and a place depending on the investor. But like any other market, especially when it comes to non-investment grade, it goes through cycles, right? And the reality is when you think about the amount of growth that we've seen in a market like that, we've seen that before, and what usually tends to happen is, at some point, right, that cycle is going to turn, And when I look at, the high yield market, for example, that usually translates into some level of loss. Again, that doesn't mean that it's not a potentially good investment.
Given all the things that are going on, what do you like? And what do you not like so much that are kind of really sensible ways to approach portfolio construction? Say, we'll transition to you, Mike, as a follow-on.
What do I like within investment-grade corporates? In general, I want to like what others like. What that means, I want to know where that marginal bid is for any of the trades that we get into. But broadly, we like financials, banks especially. We're just going through bank earnings right now, and incredible earnings, right? I mean, I think JP Morgan alone made more money this past quarter than I think the entire banking industry made 10 years ago. So it's just incredible amounts of profitability that you're seeing. We like the large cap banks because they have the diversity of the business lines. So whether they have, C&I loans, private credit, that's a big problem. Oh, don't worry about it. We have a huge markets business. We have a huge asset management business. So we do like the diversity that the large banks give us. So we like that sector a lot. Outside of that, we do like the technology space within investment corporates. We think that if you can underwrite the issuers, and as I said earlier, there's a lot of divergent performance amongst these names, but if you can pick the right names, there's a lot of performance to be had within the tech space. I'd say those are the two big spots that we like within IG. I'll leave it at that.
When we look at the airline sector today and what it's been over the last 10 years, we see a sector that's fundamentally changed structurally from what it used to be, right? It's a sector that's gone through a whole cycle of bankruptcy. That's bad and good. It's bad because they went through bankruptcy. It's good because bankruptcy allows companies to clean up all the kind of garbage that's, whether it's on their balance sheet or on their income statement. It's also an industry that's gone through a pretty severe cycle of consolidation. Probably things you guys know as a consumer, right? You go and you want to fly from point A to point B. Maybe you used to have like 8 different choices. Now maybe you have 3 if you're lucky, probably 2, sometimes 1, right? We've seen a huge period of like merger and consolidation within the industry that's actually healthy from a company perspective. The combination of like that cycle of bankruptcy and consolidation has translated into an industry that is a lot more resilient today when you look at the companies that are still around, right? And you actually have seen that translate into a pretty significant period of like upgrade activity when you think about ratings, right? Delta Airlines being the most example of a company that was high yield for the longest time, was investment grade, went back to high yield, is now back to investment grade. Hopefully we'll stay there. When we think about a theme like AI, could be a bad thing, could be a good thing, could be we don't know, let's make a best guess, but let's roll up our sleeves and do that bottoms-up analysis to try and do some differentiation because the market isn't, right? So like that type of environment where you're seeing this kind of like high correlation, right, within a sector because investors basically saying, I don't want any software in my portfolio. I don't want to liken it to like running into a burning house, but like it's literally like kind of like running into that house on fire and going, hey, like there may be something in here that's worth saving, right? If we're willing to do some of that dirty work. And so that's where we're spending most of our time in a sector like software, which is we're not trying to take a view on software per se. It's not like the airline example, but we also think that not all companies are created equal. And the market has basically acted this year as like they're all the same. And so like as an active manager, that type of, let's call it lack of dispersion, for lack of a better term, right? Where all of the companies are being treated the same, actually creates a different type of opportunity for us if we're able to kind of roll up our sleeves and do the work.
So VSDB is the Vanguard short duration bond ETF. I think the simplest way of thinking about this is it's a short core plus strategy. So around a 2.5 year duration, we run it against a universal. It has high yield in the benchmark, mortgages, treasuries, investment grade, corporate structured products, a very diversified universe. Has the ability to go below investment grade, but still predominantly investment grade. So it's just in the 2.5 year, 2 to 3 year duration bucket. So a short core plus gives us a lot of flexibility to go into investment grade, high yield, bank loans, within the credit space, mortgages. Sarah said that we like mortgages. We really do, especially given this move in rates. So it's a great fund for investors looking to move out of money markets or maybe shorter duration in their allocation and want to gain some duration exposure, but are not comfortable going farther out the curve.
How about VGMS, Mike?
Yeah, VGMS again is our multi-sector income bond ETF. It's essentially a very similar product as the mutual fund version, which we've had for longer. My view on so it's an income-oriented, credit-focused ETF. I view that strategy, the income strategy that we have, is really representing kind of like the best of what we have to offer, right? When you think about what we have to offer as kind of having differentiated views around asset class allocation, right? Think about a product that offers exposure to all parts of the credit spectrum. So whether it's investment grade credit, high yield credit, emerging markets, as well as structured products. This is a product that offers you exposure to all of those, as well as kind of like our thoughts around where the best risk reward is at the asset class level. In addition to that, like, it's a product that really gives you like full access to all of our specialist teams and all of that bottoms up alpha that we're trying to generate within these sectors. I mean, the market is just like the fundamentals of high yield have evolved quite a bit, like over the last, let's call it 10 to 15 years. Like, the secondary market has also evolved quite a bit. I would say it's also true across credit markets, right? And part of that evolution has resulted in what I would characterize as a much more robust and probably resilient secondary market liquidity. When you think about kind of the ETFs and the kind of the evolution in terms of market participants, the evolution of like portfolio trading as a key component of secondary market liquidity, these are all things that we didn't have at our disposal 10 years ago, 15 years ago, and things that I would say, all else be equal, should make for a much more resilient secondary market liquidity kind of function when we do hit these pockets of volatility.